In 2025, the US economy grew at a solid annualized pace, supported by resilient consumer spending and continued strength in services. Expectations for fourth quarter GDP were for growth to slow, but remain positive, reflecting a late cycle environment rather than a recession. The actual Q4 number came in softer than many forecasts, as higher interest rates, tighter financial conditions, and some cooling in business investment began to bite. What matters for investors is not just the headline number, but the direction of travel. Growth is moderating, but the economy is still expanding, which supports corporate earnings while reminding us that we are late in the cycle, not early. That backdrop sets the stage for how we think about both equities and fixed income today. At the same time, inflation pressures have picked up again after easing from the earlier peaks. Part of this is domestic. A still firm labor market, sticky wages, and strong demand for services keep some upward pressure on prices. But recent geopolitical tensions, particularly around the Strait of Hormuz, have added a new layer of risk through energy markets. The US doesn't import a large share of its oil directly from that region, but global oil prices are set in a global market. So any disruption to the supply flow through Hormuz can ripple through fuel, transportation, and costs worldwide. Historically, during inflationary periods, equities can still perform reasonably well, but leadership often shifts toward companies with pricing power, strong balance sheets, and the ability to protect margins even as costs rise. That is where we are focusing our equity exposure today. Another important part of today's market story is private credit. Over the past several years, private credit has grown rapidly as an alternative source of financing for companies, stepping in where banks have pulled back. Recently, markets have been sending a more cautious message. Wider spread in some areas, more selective deal-making, and a greater focus on credit quality and structure. This doesn't mean private credit is broken, but it does mean the easy phase of rapid growth of generous terms is behind us. Investors should be aware of two things. First, refinancing risks for weaker borrowers is higher in this rate environment. Second, strong managers with disciplined underwriting may still find attractive opportunities. In other words, we are more concerned about specific pockets of excess and weaker credit than less concerned about the entire private credit market failing all at once. As we close out the first quarter, corporate earnings will give us a clearer picture of how companies are navigating this environment. On a positive side, many firms have already adjusted to higher rates and inflation by improving productivity, managing costs, and in some cases maintaining healthy pricing power. Sectors tied to structural trends like technology, energy transition, and certain areas of healthcare industrials may still show solid revenue and earnings growth. On the negative side, more rate-sensitive and highly leveraged companies could feel pressure on margins, especially if wage and input costs remain elevated while demand cools. We expect greater dispersion. Not all companies will move in the same direction, which means stock selection, rather than broad market exposure, becomes increasingly important in equity portfolios. Finally, let's talk about yields and fixed income. Since the Iran conflict escalated at the end of February, we've seen a sharp move in bond markets, with yields jumping roughly 40 basis points across the curve after February 27th. Despite 3 rate cuts from the Federal Reserve over the last year, the 10-year yield treasury is around 4.3, roughly back to where it was a year ago. This tells us two things. First, markets are demanding a higher risk premium for inflation and geopolitical uncertainty. Second, investors can once again earn meaningful income from high-quality bonds. For portfolios, that means fixed income is no longer just a defensive afterthought. It is a real source of yield and diversification, especially when paired with a more selective approach of equities. In this environment, we are emphasizing quality, managing interest rate and credit risk carefully, and using both equities and bonds to keep portfolios resilient through ongoing volatility.